Okay, we're going to start our discussion of multiple time frame analysis, how to use two time frames, sequential time frames, and I'll explain what that means in a minute, to try and identify really good opportunities in the market that have low risk. The whole idea with any type of investment or trading in the stock market is you're trying to find a low risk idea. And you want a low risk idea generator, meaning something or some approach or setup that you can go to consistently over time in the market. So let's start with this chart of US Steel. On the left side of the chart, starting in 2016, this is a weekly chart, by the way, and I've got an 18 MA, an 18 simple moving average, 18-week simple moving average, and a 40-week simple moving average here. And what these lines do is they really help define the trend. If the 18 is above the 40 and both lines are rising at about the same rate, you're in a very strong trend. That's without the use of any indicators. In future videos, I'm going to go into how to use the indicators such as MACD, RSI, and ADX, but I don't believe it's necessary to identify strong trends if you're looking at the chart. The ADX and the MACD and such are really helpful and useful for screening. I use them. That's the technical, the side of technical analysis that is more computerized. And what it does is it helps you go screen and look for names. Where it's very hard to identify the parallel lines on an 18 and 40, you can go say, give me ADX that's greater than a certain number very, very easily. So we'll get into that later. But right now, I think if you focus on finding stocks that show this trend that I'm going to describe in a second, this is going to be your higher time frame, your setup time frame, or your trend time frame, however you want to call it. The trend time frame basically tells you that whatever trend that is, the one time frame lower, I'm going to take trades in the direction of that trend. So the weekly chart here of US Steel, again, starts to the upside. And if you notice here, it started at around, in the mid-teens. And by the top, it had hit 46, 47. But look at the way it did it. It made a big move up and then a huge move down and then a big move up. And it was scattered in a violent decline in 2017 and then V-bottom and went straight to a new high. This is really not the type of environment or the type of stock or pattern or trend that you really want to be trying to trade. It's just not. There's no consistency to it. There's no pattern of consistently higher highs and higher lows. You really want to look for actually what took place after 2018 and the decline that takes place. Once this went through this little transitional phase and we get the violent sort of bar here that gets the trend going to the downside, look what happens to the moving averages. Now you have a declining 18, you have a declining 40, and look at they're almost parallel. And they stay that way for over a year. This right here is trend. This is the type of trend you want to be focusing your efforts on. You want to take every time this rallies up towards the 18 MA, you want to be going and looking at your daily chart in this case, because this is a weekly trend. So I'm going to go down to a daily. And when I use two different time frames, I'm usually taking the higher time frame and then dividing it by 5 units. So if you think about there's 5 days in a week, that's the perfect, I use that from Alexander Elder's Trading for a Living. I read that way back, and I've always used that 1-to-5 ratio. So the lower time frame is 1 unit, the higher time frame would be 5 units higher than that. Once we get down to like the hourly, it doesn't work quite as well. I mean, if you want to use a 78-minute chart, you can do that, but I think it's a lot easier just to stick with the 60-minute and the daily. 60-minute is much more widely used. There is a difference, but it's not significant. I think you can make the adjustments. You'll see what the adjustments are. And if I'm going to err on the side of being a different ratio than 1 to 5, I want it to be slightly larger. 1 to 6 is fine. You get to 1 to 8, 1 to 9, then I think you're going to have to make adjustments into how you read the different trends. But if you stick with 1 to 5, 1 to 6, I think this approach that I'm going to show you works exceptionally well. If you go to 1 to 4, it will work, but it'll give you a lot fewer signals. So I would stick with 1 to 5 to 1 to 6 as a ratio. So I like using like a 30-minute chart with a 5-minute chart if I'm going to trade on an intraday basis. I don't really do that much anymore. I don't have the time for it, but you can find a lot of patterns like the one I'm going to describe today that really kind of meet this criteria on a 30-minute, 5-minute combo. 60 and 10-minute. The 60 and 15, which is a 15-minute, is very widely used, is also popular. But I got to tell you, I just don't. Again, I don't see as many signals. I think if you use a 60-minute with a 10-minute, this approach, the exact signals that I'm talking about, will show up a lot more often. So I just want to make sure we're focused on trend. And again, I'll show you a few things with the indicators that'll show you when you're really trading a pure trend. But if you stick with this pattern, and even if you're using a 20 instead of an 18, it really doesn't matter. You could use a 21, a 20, 18. I like the 40 as the higher time frame. You could use a 50, but then you might not have the same parallel. It's going to take a little longer to roll over. The trend takes a little longer to get in place, and you might miss that first signal if you're using a 50. It's not the end of the world, and you could make some adjustments for that as well. But what you're looking for is strong trend like this, and then you're looking to take rallies. In this case, because it's a downtrend, look for rallies against the trend near the 18, and then go down to your lower time frame. I'm going to bring up. I'm just going to scoot this over and show you. So let's look at this period here. Is the beginning, this big rally that we had counter to the trend. So this rally's up 5 or 6, 7 weeks, but you still have a strongly declining 18-week and a strongly declining 40-week. So I'm going to go and look at the daily chart, and I'm going to look for the counter signal. So Don Miller is a famous very successful E-mini trader. And he does this type of strategy with shorter term moving averages, but he also does them on very short, tiny time frames. But the pattern and the whole process is identical. So I'm looking for, if you notice, the 18 is below the 40 on the weekly chart, and they're both declining. Well, look at the opposing trend taking place on the daily. 18 is above the 40, and actually they're both rising here. Okay, so I'm actually looking for what we call, or what Don would call, an opposing trend trigger, which means I'm in an uptrend on a daily chart, which is counter to the trend time frame. This is the time frame you want to trade. So that's the trend you want to be playing. Anything in that direction. So we're only looking for shorts now on the daily chart. Once we get to this daily chart, we're going to go look for a signal that suggests that the daily chart is going back in line with the weekly chart, meaning the trend is turning down. So in this case, you had the rising 18 and 40, but the moment you go flying down through the 40, this trend is breaking down. That's a very aggressive entry there. If you wanted, so you could take the break of the 40 as your short signal, because that's basically getting you back in line with the weekly trend. So the entry would have been somewhere around 22, something like that. And if you look on the weekly chart, that would have put you in right about there. I mean, you look at that, it's really pretty good. It's getting you right in line with the main trend. The problem I have with this entry at 22 is that there's nowhere to put your stop. If I'm trying to protect myself against a little rally here, I don't want to just put it, somewhere in here. Even above the 18, sometimes you could go get nicked out of it. You'd really have to put it against the last peak, or maybe you could use this peak here. That's still pretty far away. Again, I'm looking for a low risk idea generator. So I'm going to probably identify this signal where, again, now look what takes place. 18 below the 40, and this line's declining, and now this line's declining, and then you start to come down through. It's actually, believe it or not, this bar, as it's coming down through this 18, would have looked pretty ugly. And then by the end of the day, it came back a little bit. I still would have been taking this down bar coming down through the 18 because it was declining 18. You had a declining 40. And look at the risk reward in this trade. So I'm getting in here and I'm only risking to here. That's a significant difference than this. The distance from here to here is much greater than the distance from here to here as a stop, because I'm going to use the last peak as my stop point. So this gets you in right as the stock is really accelerating. And if the one thing I want you to take from this is what you're looking for is a match. You want to match on you want to take the 2 time frames and look for the conditions in place where 18 and the 40 are down and the 18 and 40 are down in both time frames. And if you do that, your chances of success are going to increase dramatically.